Hi, Dylan, Jen, and John. Dylan, let me promote you to a panelist. Okay, Dylan's just rejoining in a moment. Hey.
Thank you.
How you doing?
How are you?
Very
Good.
well,
How are you?
thanks. Good. Oh, we've got a bit of a lag there. Let me share my screen and confirm that you can in fact see it, of course. Is that visible?
It is. Thank you.
All right, excellent. Well, we'll get started in just a second. And I'm thrilled to have you on the line here, Dylan.
Thank you. Thrilled to be here.
All right, give it another moment or so. And we'll get started. Okay. Well, seeing as it is now 1:30, I'm going to go into full screen and get started here. Okay, so welcome to today's presentation, a case study in Australian American stock awards and their taxation across borders. I am Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia, and I'm thrilled to be joined here by AUSA tax partner, representative, director. I guess we haven't gotten so far as job titles there, Dylan, but I'll just introduce Dylan Goldspring in a moment. But before that, I did really want to emphasize that today's presentation does not constitute personal, financial, tax, or investment advice. You would be wise to consult with a tax or a financial advisor on your specific situation. And of course, be sure to check out our YouTube channel where you can subscribe. You'll see that last month's presentation, where we did an introduction to stock awards and then tax treatment across borders, with the introduction of various different concepts made in that particular presentation, that is now up, as is about 40 other, or as are about 40 or 50 other videos. So a little bit about me. Dylan, did you want to take this away here?
Very happily. So I'm happy to introduce someone that I'm sure many of you already know, Ashley Murphy. Ashley is the founder, executive director of Arete Wealth Specialists or Strategists Australia, and also of the Global Financial Planning Institute. Ashley is a tri-citizen, born in the UK to an Australian dad and an American mother, raised in Brisbane, Queensland, which is coincidentally just up the road from myself. Studied at the University of Queensland, undergraduate studies in business management and IT, moved permanently to the US in 2005 and worked as a corporate financial analyst, completed his CFP and CFA studies in 2012, has worked with the Financial Planning Association, founded Arete Wealth Strategists in 2013, completed his Australian graduate diploma in financial planning in 2018, and has actually been a professor at UC Berkeley and Golden Gate University.
Well, thank you very much, Dylan. And let me introduce Dylan Goldspring to you, who if you're wondering about the initials there after his name, that is a chartered accountant and fellow of the Tax Institute in Australia. So Dylan, as you mentioned, I'm in Brisbane. Dylan's on the Gold Coast. Dylan attended Griffith University for a Bachelor of Commerce in Accounting, Master of International Law. Dylan just loves study, it would seem. I guess we share a common interest in that regard, and that we're interested in constantly adding to our knowledge. So Dylan's currently doing a PhD in international tax. He's got a graduate diploma in immigration law, which essentially means he has the perfect combination of academic training and practical experience, for that matter, to do what he does today. And that would be, he founded CDG Corporate in 2017, a public practice accounting firm, and he focuses on taxation to do with cross-border transactions. So welcome, Dylan. Okay.
Thank you.
And just a few issues that we here at Arete Wealth Strategists deal with. That would be Aussie business owners living and leaving the US. high net worth Aussie families currently in the US, or Australian executive families permanently relocating to the US and wanting to get their financial affairs in order. Okay, so today's presentation and the outline for today's presentation is as you see here. So we're going to introduce a fictitious couple, run through their balance sheet, their income, the stock award situation that they find themselves looking at, address the financial planning concerns that they have. And in so doing, we need to talk about a number of different things. So tax residency and different types of tax systems, the tax treatment of stock awards in Australia and the US, and how they would differ where there is a lot that vests across both countries, how Australia and the US differ in their treatment of the taxable basis of an asset, and then lastly, case study scenarios in Australian versus US taxation. And then questions at the end, of course. Okay, so Robert and Sarah Voss, 42 years of age, Australian citizens living and working in Sydney presently. Robert's a senior executive at Graphic Design Co., making about $400,000 a year. He's been notified that in 2 years' time, his company wants to send him to the US. So actually, that should be July 2024. So it's notified that we'll be requiring him to move to the US in 2 years' time on July 1st, 2024. Let me fix that up. He's on an E3 visa, and we can see his balance sheet below here. So fairly evenly split between Robert and Sarah, the total net worth of 3.45 million Australian dollars. Okay, let's just correct that, because these years actually do matter quite a bit in going through this case study. Okay, so Graphic Design Co. have approached him and said, we want to give you 400,000 restricted stock units on a 4-year quarterly vesting schedule with a 1-year cliff. So the grant will be made on July 1st, 22, meaning that the very first vest will be on July 1st of 23, with quarterly vesting thereafter for the remaining 3 years. Current value of Graphic Design Co. is $10 per share, meaning that the unvested value of this RSU package that Graphic Design Co. is giving Robert is worth 4 million Australian dollars. Robert thinks the best strategy will simply be to sell his stock once the company goes public and he's outside of his blackout period being a period of time for senior execs where they're not allowed to sell because of insider information they may be exposed to. Robert's optimistic about the direction of the company and thinks it could more than double over the coming 4 years, and thinks that there's likely to be an IPO set at that point in the future. So this is what we see in terms of the vesting schedule. We see a quarter of the vest occur 1 year from July 1st, 2022. There's a market value of $1 million. You'll see the cells in green represent the time that Robert and family are in Australia before moving to the US for the remainder of the period. The financial planning concerns that they have expressed include the following. They said, we want to know what the ATO is going to tax me when these RSUs vest. What happens once they vest and I then sell the stock, where there's some gain inherent in those stocks. What about when I leave the country? Is there any tax due at that point in time? How about in the US? I plan on going there. What's the IRS's taxation of the RSUs as they vest in the US? What if I then sell the stock? What if I leave the US? And departure planning for the US and any financial decisions he needs to consider there. And then lastly, what to do with the family's Sydney residence as they think about leaving. Okay, so I'm going to hand it over to Dylan right now to talk about tax residency and types of tax systems.
So, excuse me, being a tax-related topic, I'll make it as interesting as I possibly can, but also as succinct as possible. So with the US and Australia, both have incredibly well-defined tax residency tests. There are key differences between the two of them. However, generally, The tests will specify who will be a primary tax resident and which country will tax their worldwide income as opposed to their locally sourced income. And there are a few important distinctions to make between the two types of testing. Now, on the next slide, the two types of tests are typically territorial or citizenship-based systems. The USA practices on a citizenship-based model whereby they will tax a permanent resident or a green card holder or anyone that is substantially present in the US, which we'll cover in a bit more detail in the next few slides, even if they're not physically in the US at that point in time. So unlike in a territorial-based taxation system, the tax residency for a US citizen or green card holder will actually follow them around the world, regardless of where they're currently located. Now, Australia practicing on a territorial-based taxation system, it depends on their physical presence in the country at that point in time. And that's the key difference between the US and the Australian-based systems. Now, in the context of Robert is only on a temporary visa whilst he's in the US. So when he becomes a US tax resident under one of the US domestic tests, he will actually be taxed on his worldwide income in the US. However, his US tax residency will cease once he leaves the US, as he's not a citizen or a green card holder at this point in time. So covering on the Australian domestic tests specifically, there's actually quite a bit of change in this space, and it is coming up probably over the next year or two where the government's implementing new tests to circumvent or to supersede the existing tests. However, as it stands, the top 4 dot points apply. Now, those top 4 dot points, the first test that we consider is the resides test, and the resides test is based strictly around their actual residency, their living arrangements, physical presence, economic ties, and social ties. So it's quite a discretionary test that needs to be applied. Similarly, the domicile test will look specifically at their place of permanent home as legally defined in Australia under common law. The 183-day test is quite a clear-cut test whereby if an individual spends 183 days or more in Australia, they will by default become an Australian tax resident. And the Commonwealth superannuation test applies to any individuals regardless of their location. They become an Australian tax resident if they are a member of a Commonwealth superannuation scheme. Now, briefly on the new tests that are looking at being implemented in the coming years, they're removing a lot of the discretion and a lot of the ambiguity around the existing resides and domicile test and replacing it strictly with the 183-day test. So with the 183-day test, spending more than 183 days in Australia in an income tax year will by default apply you as a resident. The secondary factor test, where 2 factors will need to be met out of 4, will apply to the discretionary tests that were previously located under the resides test. So again, considering intention, accommodation, social arrangements, and economic ties.
Dylan,
yes.
let's just throw in a random question here. What if someone is a citizen of both countries and they spend more than 183 days? Let's say you're a citizen of the US and Australia, you're back in Australia, yet you have stronger ties back to the US. How does that work? This is a tiebreaker situation.
Sure. So thankfully, we have a little bit of guidance in that space as well. However, there is a bit of ambiguity in the space too. What we would actually apply is called a bilateral treaty or a convention, or more commonly known as a tax treaty. So the tax treaty specifically between Australia and the US contains what's called a tiebreaker provision, where the treaty actually is an agreement between the two governments to say, okay, well, these are the factors where we'll actually say you're more closely connected to the US or more closely connected to Australia. So applying the tiebreaker tests is how we would determine where the primary tax residency is.
Mm-hmm. Okay, great, thank you.
So with US tax residency, I'm sure many of you are more familiar with the US tax residency than with Australian. However, again, reiterating what we said before, primarily a citizenship-based model whereby a US citizen will automatically be a tax resident regardless of their location, similarly to a green card holder who is also permanently brought into that US taxation system. So There are a number of other tests which are less concrete, I would say, than the citizenship and green card tests. And the main one is the substantial presence test. So this is regardless of the visa that they're currently holding. If they meet the conditions under the substantial presence test, they will become a primary tax resident in the US. And that requires 31 days of residency or actual boots on the ground in the US in the current tax year. And it also requires a combined total of 183 days in the total of the past 3 years, which includes 100% of the days in the current tax year, 1/3 of the days in the previous tax year, and 1/6 of the days count towards this test in the tax year before that. So it's a combined running total over the past 3 years to say that you're substantially present in the US. There are two other somewhat common situations which will bring individual into the US taxation system. That is a first-year choice, whereby you may meet the substantial presence test in a later year, but in the current year, you're wanting to opt into the tax system, you can make that elective choice. And a non-resident spouse of a US taxpayer can also become a US tax resident. Sorry, Ash.
So Dylan, just expanding there in that first year choice, this would seem like a situation where if an Australian was moving, let's say, in the second quarter of the calendar year, which is the fourth quarter of the Australian financial year, that might, and they were in that 45% bracket, they've made above $180,000 a year. Would that seem like an example of where they might like to bring forward there and exercise this first year choice to become a US tax resident sooner, to begin taxation at the lower marginal rates in the US?
Exactly correct. And that's the thing. In terms of taxation planning, a lot of the time we really need to focus on timing. So particularly given that the two tax years are obviously on a different schedule, there is quite a large ability to implement tax planning. So bringing forward that first year choice and becoming a primary tax resident in the US when you've already busted through your income brackets in Australia could be a viable option, subject to formally tax planning it out.
Okay, great.
Now, with Robert, does he have accommodation in the United States? Yes, he does. Is he going to be employed for a minimum of 2 years? And will he spend less than 45 days in Australia during each income tax year? The reason that those three options are spelled out is because when you're ceasing Australian tax residency, it can be clear cut or it can be extended. Under the new tests state that if the individual moving overseas will have a permanent place of accommodation in that foreign country, will be employed for at least 2 years, and will spend less than 45 days in Australia in each income tax year moving forward, he will cease Australian tax residency as soon as he leaves for the United States. And that's an incredibly important point, because recall that under tax residency laws, as soon as Robert becomes a United States tax resident as opposed to an Australian tax resident, he no longer needs to declare foreign sourced income in Australia. And that's particularly relevant if he's got a higher income bracket, which he does, particularly with the RSUs. So after the date that Robert leaves the United States, he will cease to be an Australian tax resident.
You said foreign sourced income. Do you mean employment income?
Employment income, yes. So theoretically, if Robert's moved over to the United States, he is now employed by the United States. He's working in the United States. As far as Australia is concerned, because that employment is now offshore and he's a non-resident for Australian tax purposes, there is no need to declare that income to the Australian government if he's not a resident.
Okay, wonderful. All right, next. So we're talking about the tax treatment of stock awards in Australia. I believe this is you, Dylan.
Now, this is the most interesting topic of them all. You can call me a little bit of a tax nerd in this space. So under Australian taxation law, strictly domestically, what we're talking about is non-cash compensation, so equity compensation. Now, equity compensation is dealt with under what's called the Employee Share Scheme rules, or commonly the ESS rules in Australia. Now, the ESS rules, because equity compensation can be quite complex and new instruments are regularly offered all the time, the rules do change quite regularly. So in this particular forum, we're going to mainly focus on the ESS granted after July 2015. Now, broadly speaking, employee share scheme rules apply to individuals who receive an equity stake in the company for which they work, and that equity stake is obviously non-cash compensation. The rules mainly aim to spell out two important things: the timing of each taxing point, and also to allocate the income between ordinary income and capital income, because there is an element of both. Now, example number one, with an employee share scheme and how we actually determine the taxing point, we need to first determine if there is a real risk of forfeiture for the equity compensation they're receiving. So a common example here would be if there is a performance hurdle or a minimum term of employment or a good leaver condition whereby some kind of condition needs to be met before the equity compensation is unconditionally granted. If that is the case, it is possible for the taxation of the equity compensation to be deferred to a certain later point in time when the unconditional grant becomes true. And for that to happen, the employee must not own 10% or more of the underlying company and not have 10% or more control of the underlying company, otherwise we will not qualify for that concessional deferred taxing point. Note very importantly that the 10% ownership and control rule also applies to associates, and associates under Australian law is quite broadly defined to family members or close contacts. So there is a real risk of contamination if we're talking a relatively small proprietary company. So a serious consideration in that space. In terms of determining a real risk of forfeiture, like we mentioned before, performance hurdles, minimum term of employment are particularly relevant. However, under the actual tax law itself, which you'll see at the base of that slide, it's incredibly ambiguous. We just need to determine that the risk of forfeiture is real. It must be genuine, not nominal, artificial, or created or orchestrated in any way. It must be a genuine risk that the equity compensation may not come to fruition. So, okay. The other condition or situation where an individual may receive concessional treatment by deferring the taxing point of the equity compensation is if there's a disposal restriction. And this is going to be quite relevant in the equity compensation space. Again, they must pass the 10% ownership and control test where they don't have 10% or more ownership or control of the company, including their associates. And the deferred taxing point will actually occur, and just for clarification here, the deferred taxing point is the first point in which the Australian Taxation Office will tax the equity offering. They will tax it at the point where there is no longer a risk of forfeiture and there are no longer any restrictions regarding disposal. It can also happen in the event that the employment ceases, the employment of the individual ceases, and they receive that kind of equity compensation as part of their payout. Importantly, with a right to exercise stock, which we won't cover in too much detail here, if 15 years has lapsed since the original grant of that right, the ATO will seek to tax it at market value at that point in time. And so there is a real risk there as well that if you hold a right for an indefinite period of time, the ATO could come knocking at some point in the future.
So Dylan, would a disposal restriction be considered, would a blackout period be considered a disposal restriction? So senior execs can't sell because they're exposed to inside information, potentially can't sell. Does that defer that taxing point? Will that count as a disposal restriction?
It can definitely, yeah. So that is actually probably one of the more common examples of a disposal restriction where, exactly correct, there is some kind of contractual obligation where that individual cannot dispose of the equity and receive the cash value. And just recall, from a practical standpoint, you have to imagine that these rules exist primarily so that people aren't going to have to pay tax on something that is illiquid, because at that point in time, they would need to dip into their personal reserves to be able to pay the tax on something they may or may not be able to sell.
Yeah, okay.
Now, with Robert acquires shares on the 1st of July, or sorry, the rights to shares on the 1st of July, 2022. Now, importantly, that right is a non-transferable right. So that is one of the disposal restrictions that we just covered off on now. Importantly as well, the right to exercise and receive the underlying equity is subject to performance conditions, which at this point, Robert has not yet met. On the 1st of July 2023, Robert satisfies the final performance conditions related to the right, but did not yet exercise the right. Now, again, strictly we're speaking of a right here, a right to underlying securities. So because the right is non-transferable, as we mentioned before, there still exists a disposal restriction on the equity. So the deferred taxing point won't yet occur because as far as we're concerned, it's still an illiquid security. The right is non-transferable, it's the share that is. If Robert was to exercise on the 1st of September 2023, he received shares. There are no longer any disposal restrictions with the underlying security. So at that point, we have the deferred taxing point. Now, when the deferred taxing point occurs, it's actually going to be the recognition of ordinary income. So at this point, we're not talking capital income, it's just ordinary income. He's received the underlying securities as part of his employment. Robert will be taxed on the difference between the market value of the shares obtained, less any amounts contributed to those shares.
All right.
And Ashley, I may, actually, no, sorry, I will cover on this one, my apologies. So again, if we're looking at the vesting schedule here, more or less at the time that each of these stocks vest, Robert will be taxed on these amounts as ordinary income when the amounts vest or when he converts the securities, the right to shares. At a later point in time, there will be a capital income consideration, but at each of these stages here, it will be considered ordinary income.
So in all likelihood, we're looking at 45%. Certainly for that first tranche, the $1 million, he's only going to walk away with 550,000 and so on and so forth with the remaining lots that go through.
Exactly right. And the risk there as well is obviously that at this point, we're assuming that Robert has received the securities, but not yet sold them. So there's a significant tax consideration there in terms of being able to physically pay the tax.
Yeah, yeah. Okay, so tax treatment of stock awards in the US. Did you want to tackle this one, or is this for me?
I might pass this one over to you just for a little break, if that's okay.
Sure, yeah. So it's pretty straightforward. It's remarkably simple. It's really the same as Australia. They use different language to describe it, but it's essentially the same treatment. It's not until it's vested, essentially, and that restriction has been removed, that it would be considered taxable income to an individual. And so what we see here is by July 1st, 2024, Robert and his family moving to the US. There's a quarterly tranche of 25,000 shares that vest at $15 a share. Thus, 15 times 25, 375,000 Australian dollars, or 273,500 of ordinary income would be realized at that point in time. Now, we're assuming July 1st is an interesting date because depending on the slide, he leaves, as we all know, if anyone's flown from Australia to the US would know that you leave in the morning and you arrive in the afternoon on the same day because you're going over the international time zone. So this is an interesting day that's happening right here. So he becomes a US tax resident on this day, and that income would therefore be taxable in the US. So one interesting thought exercise I go through when speaking with prospective clients is this. I say, if your company wrote you a bonus check for cash today, they said, here you go, you've done such a great job. We're going to give you 375,000 Australian dollars, 273,500 US dollars. Would you go out immediately and buy shares in your company? And basically no one ever answers yes to that question. And it's funny because by default, that's what RSUs are doing, is that you're accruing stock in a particular company. You need to stop and ask yourself, is this the best investment choice that you could be making? Okay, so continuing on with the presentation here, the cost basis of the shares is equal to the stock price on the day of the conversion from RSUs to actual stock. So therefore, the cost basis is $15. So if the stock price increases above that, then we have ourselves a capital gain. So what we're looking at here on this slide is showing us the remaining couple years of the vesting schedule, where 25,000 per quarter of vesting, and you see the stock price increasing. So that's going to be treated in the US as ordinary income. Is there any Australian tax owing on these amounts? The answer is no, not on these lots. We have to be very specific, because the first lots that vested in Australia, that was related to being a tax resident, that was related to the service for the company when they were present and a tax resident in Australia. Now we're talking about while working for the same company, the US branch of the same company, they're US tax residents, and so it's treated as ordinary income in Australia. So what about taxation of RSUs granted in Australia that vest while in the US? Now this is a curly one, not one that we have modeled in the table, but this is one that's more likely to happen in reality. And that is, what happens if Robert didn't happen to move on the very 1st of July, exactly on the day of a vest, instead moved partway through a quarter? Well, that's pretty straightforward as well. That's really to do with the count of days, depending on the country where he worked. And Dylan went over earlier talking about how with the new Australian tax residency rules, it's pretty cut and dried. If someone has accommodation, expect the job to last 2 years. And if there was there another factor in there, Dylan?
More or less, if they don't intend to return for 45 days in each year at a time. Yeah.
Thank you. So if that's the case, then it's really straightforward. The only confounding variable here is that this compensation is simply not paid in cash, it's paid in stock. So it's actually remarkably straightforward. So let's throw a curveball at Dylan. Does our friend Robert here become an Australian tax resident if he returns home for 2 weeks of vacation throughout his time in the US?
So theoretically, no. Again, if we're looking at the new tax rules, which I will focus on just because they're less ambiguous than the existing and they're likely to pass through law, more or less in terms of the primary test, he hasn't satisfied the 183-day test. Has he satisfied the 45-day test? No, it's only a 2-week period. So there's actually no need to pass the factor tests, which ironically, Robert would pass the factor test. So he does have a genuine risk if he returns for 45 days or more. But for 2 weeks in vacation, no risk at all under the new rules.
Wonderful. Okay, next section here is how Australia and the US differ in their treatment of the taxable basis. And this is an interesting one indeed. So, Dylan, did you want to take this one, or would you like me to run with it?
I'll jump in on the Australian part at the very least. So I think one thing worth noting here is that regardless of whether the stock is publicly traded, privately traded, the ATO will look to view the tax basis of that underlying security that Robert receives to be the fair market value on the date that he acquires the asset as an Australian tax resident. So it does offer the possibility of tax savings when returning to Australia with low basis assets that were acquired abroad. With regards to Robert, if he sells any of his existing holdings whilst a US tax resident, there are going to be a number of considerations that we need to review, which we'll cover in the next couple of slides. Ash, I'll pass you over to the US.
And where the US differs and is unique and not in a good way is that regardless of your legal status with the US and when you acquire an asset, once you become a US tax resident, Uncle Sam is going to look to their original basis back in your country before you may have ever thought about moving to the US. So that does offer a very nasty surprise to when people realize that. And it emphasizes the need for tax planning when someone is thinking about moving to the US. In fact, I think some of the other slides we have coming up, particularly to do with taxable Australian property, I think also further emphasize the need for planning to avoid some very unpleasant surprises. So two scenarios we wanted to share with you here today. So what if Robert sells the Graphic Design Co. stock that vested while he was in Australia, while he worked in Australia, as soon as he arrives in the US? So keep in mind, capital gains, unlike dividends, are sourced to the country of primary tax residence. Now we have Robert living in the US. The basis for determining his gain is going to be the original stock price. So what does that look like? We have a total gain of the combined value here. It's on the next slide, actually, that we go into that. Oh, excuse me, no, it's not. So the combined gain is the total of those two sums there. So it comes out to be $300 and something thousand. And the US, now that he's a US tax resident, they're going to look all the way back to when he was originally granted these shares. He's paid a lot of Australian tax on them. That's all said and done. That's in the past. It's the gain that we're concerned about. So despite only being in the US for one day at this point in time, he already has this accrued tax obligation. Now, what if, let's go into the future a few years, back in the future in 2026, after July 1st, Robert returns back to Australia. What about the Graphic Design Co. shares that were granted to him, invested to him while he was in the US? Well, this is a good news story. This is very happy news indeed. So it's essentially saying that all of the gain that occurred on these lots while he's in the US, he will return to Australia, and Australia will say, well, we don't know what your original basis was on that. What we're going to do is treat it at the fair market value of this stock today. And so that's going to be very valuable indeed to Robert being able to return. Now, Dylan, let me throw a curveball at you. How would that situation change if Robert had become a green card holder of the US and then returns to Australia?
Then we have a couple of other considerations, mainly the potential implications of the HART Act, whereby there could be a exit tax on cessation of his green card in the US, and that would need to essentially be vetted very, very seriously prior to making that decision.
Yeah, or alternatively, what if he didn't want to give up his green card and he wanted to keep it? Then how would that tax situation work?
In that case, there's the potential, or the true potential, that the US tax system would actually follow him regardless of where he goes. So again, recalling our residency rules at the start, green card holders and US citizens will indefinitely be members of the US tax system unless that is revoked or they cancel.
Fantastic. Thank you for that. All right. And so looking at case study scenarios, Australian versus US taxation, this is where we go into quite a bit of depth. So Dylan, I believe I'll hand it over to you at this point for the tax treatment on departure from Australia.
Okay, so as we briefly mentioned just then, we have the implications of the HART Act, which imposes an exit tax on the US side. Similarly, we have a consideration on the Australian side, which operates in a similar manner, but it's essentially called a deemed disposal, and it applies to any assets that are not taxable Australian property. Now, taxable Australian property, actually, I believe we're going to cover that on the next slide, but essentially a deemed disposal is the ATO views that you have disposed of any capital gains tax asset except for taxable Australian property at the fair market value on the day that you cease to be an Australian tax resident. So if you have a parcel of $100 in shares, the market value is $100. At the day that you cease Australian tax residency, the ATO will look to tax those shares on whatever the underlying gain is. Now, it is a bit of a trap in the sense that not too many people actually are even aware that Australia does have this pseudo exit tax.
I'm glad we're addressing it now, that's for sure.
Yeah, it can be a nasty one if not caught early. So taxable Australian property essentially encompasses real estate, land, or any other pseudo land ownership. So for example, a real estate investment trust or Arete. Now, there is an exception that can apply to any other capital assets, including financial products, i.e. shares, the equity compensation we're talking about here. where Australian residents ceasing to be an Australian tax resident have the option at that point in time when they're ceasing their residency to defer the taxation or the deemed disposal of those capital assets to a later point in time. If that deferral election is made, those assets then become taxable Australian property. Now, with taxable Australian property, it will essentially follow you around the world. So regardless of the fact that you're no longer an Australian tax resident because you've left, if you've elected to defer that gain and treat those underlying assets as taxable Australian property, the ATO will have the right to tax you on the disposal of those assets or the gain on the disposal of those assets when they're sold, regardless of where you are at that point in time. So in that sense, the Australian taxation system follows you in a very similar way to the US tax system.
The difference being, it would seem to me, is that the ATO doesn't quite have the enforcement muscle and strength that the IRS does. And so this is just my characterization of it. It's more that Australia is a highly desirable country to return to. And so when you return, if you haven't settled up on your tax obligations prior to departure, then the ATO is not going to forget about that, and you'll be on the hook when you return back to Australia. Of course, we would never encourage anyone to do that. It's more the case that people don't know, and they would engage with a tax professional as they're thinking about moving, and then discover something like this, and it's not a happy story necessarily.
Exactly. That's the risk here, is that realistically the enforcement of it is quite limited, or has typically been quite limited, because there's not an easy mechanism to discover these facts. But it is a significant risk, because if you are caught out at some point in the future, there's the chance of pretty serious interest and penalties being applied by the ATO.
And it seems what's worse is if someone unwittingly makes a sale of one of these assets that became taxable Australian property while abroad, then they're going to get hit with a non-resident tax rate, right, Dylan? This is your slide. I don't want to steal your
I'm happy for you to talk tax. So I think, yeah, as Ashley just said, the implication if you sell taxable Australian property overseas is that the individual will be taxed as a non-resident under Australian law. Now, two very important considerations. One, as you can see in the table there aren't a lot of tax concessions at the lower income tiers. So unlike as an Australian tax resident, where we received the first 18,200 tax-free, and then the next 27 odd thousand at a concessional rate, non-residents jump straight to 32.5%. So you are going to pay more tax off the bat. In addition to that, non-residents are typically not entitled to the capital gains tax discount, which some of you may be aware of, whereby if you sell a capital asset that you've held for 12 months or more, you will typically only be taxed by the ATO on half of that gain. Now, that doesn't apply to non-residents. So if you cease your tax residency in Australia and then later sell taxable Australian property that the ATO has the right to tax, you're really signing yourself up for a lot of extra taxes.
Okay.
And yeah, exactly that. So non-residents are not typically eligible for that 50% CGT discount. Now, in the absence, I might just jump back if that's okay, Ash.
Sure, yeah.
Yep. So one consideration here to think about is treaty relief, tax treaty relief. Now, in particular, the concept of taxable Australian property isn't covered in a level of detail in the treaty that gives any real clarification. So the risk is that if that taxing event occurs where taxable Australian property is sold as a non-resident, it may lead to a significantly higher rate of tax, because the US will also look to tax that underlying asset as well.
Okay. So I believe this one is mine right here. All right. So scenario one, Robert pays the ATO for the gain on his share portfolio at departure from Australia. So at that point in time, as we can see here, his accrued graphic design co-portfolio is worth 1.6 million and change, and we can see that actually that's for, excuse me, where is that? That should be actually it's on a different sheet right over here. We would see it's worth 1.619 right here, just where my cursor is, in cell I7. So 1.619 million is what that's worth. There's a $316,000 gain. That's the sum of these two figures here, the 275 plus 41,250. And so that's what he is on the hook for at departure. Now, how is that treated specifically? You can see here in the far right column, only that initial vest, that initial lot of 100,000 is going to be long-term because it's now 1 year later. The rest of it will be short-term. So he'll get a long-term capital gains discount only on that first tranche. And this is how it looks. So 275 of gain is taxed at half of 45%. So ends up being 61,875. And the remaining short-term gain, because the stock price, well, there wasn't any additional gain after the stock price moved from 12 to 15. So those two latest tranches don't have any gain on them. So we're simply looking at a 45% rate on that 41,250 of gain, so 18,562. That's an important number to remember. If we combine these two together, you end up with a number a little less than $80,000, 80,000 Australian dollars, and we compare that to what that obligation would be if he were to sell this exact same portfolio when in the US, where he's subject to US tax. And there is somewhat of an unknown, as Dylan alluded to a moment ago, with regards to how that if there's a tax credit applied to what is owing to Australia. Scenario 2, Robert does not pay the ATO for the gain on his share portfolio at departure from Australia. Dylan, do you want to take this one?
Yeah, I can. So essentially, again, just recall that if Robert makes that decision to defer the gain to a later point in time, that asset will become taxable Australian property. So the ATO will essentially remember that and look to tax it at a point in the future. So if the value of that portfolio had risen to about 3.1 million by 1st of July 2025, Robert wants to diversify his holdings, so he decides to sell down the stock that he received. Now, recalling that capital gains are sourced to the country of primary tax residence under the treaty means that the US will have first taxing rights to the gain. Now, again, recalling what Ashley mentioned earlier, whereby the taxable basis is the original cost basis of the asset, not the cost basis when he became a US tax resident. So the US will look to essentially tax the entire gain that he's made across the duration of the holding. The implication there is that the ATO is also going to look to do the same thing. And given that there's very little clarification under the treaty with how deferred deemed disposal is looked at in the eyes of the ATO, there is the possibility that the ATO is essentially going to duplicate that tax. And we're not even sure whether or not foreign tax credits could be applied, because as far as the ATO is concerned, that's a domestic earn. Because he is selling taxable Australian property, he's more or less declared that those assets are Australian property. So whether or not we can apply foreign tax credits to an Australian gain is a question on the ATO's side.
Just to make a finer point there, Dylan, the ATO would not seek to tax him on those lots of shares that vested while he was a US tax resident, though, right? It's only on the initial tranches, which of course have the highest gain, and therefore would have the highest capital gains tax applied.
Exactly correct. So we're looking just at Robert's holding, or the ATO is looking just at Robert's holding as of the date he ceased Australian tax residency. So whatever shares he held at that point in time, if he deferred those gains, those are the ones that become taxable Australian property.
And that's what we see right here. This is the spreadsheet supporting what you were just saying a moment ago, Dylan. So the total, that's how we end up with a total capital gain on all unsold lots of 961. So that's what the US would want to tax him on, and Australia would want to tax him on that 797, because that's now the current value of what became taxable Australian property because he didn't settle up with the ATO at the time of departure. Very good. And some more caveats you might like to add there, Dylan, about California state tax and just the uncertainty given the lack of legislation on this particular situation.
Yeah, exactly right. And this is the consideration is that the US federal tax system will seek to tax him. As Robert's currently living in California, the state will also look to tax him. And again, covering off on the fact that the shares that he owned at the point that he ceased Australian tax residency have now become taxable Australian property, which means the ATO is going to look at taxing him as a non-resident and not to give him any CGT discounts, so none of the 50% discount. And again, we're not even able to fully quantify whether or not he would receive any foreign tax credits on those gains because we're talking about taxable Australian property. So the ATO is looking at it as a domestic gain. So there is a real risk that there's going to be some serious tax consequences if Robert was disposing any of those securities whilst living in the United States.
Another thing worth mentioning that doesn't quite jump off the page here is when we look at the marginal rate of tax that's being paid while in the US. So if Robert's making 400,000, I know it's Australian dollars, but let's say he makes 400,000 US when he moves, and he's also getting 375 of these RSUs, that's putting him into a 37 federal bracket. I don't know if it'll bring him quite up to 12.3 in California. No, not quite, but in 10.3, 11.3, somewhere around there. And then don't forget the net investment income tax that came about at the time of the Affordable Care Act. So another 3.8%. Add all of that up, and you're actually in a higher marginal rate than what you pay in Australia, even with the Medicare surtax, which would bring you to 47%. We're looking at around 50, I think that's 52.8% for a high income earner in a state like California. So just something to be aware of. I just wanted, before going to questions, I just wanted to go back and see that in fact, we have addressed the financial planning concerns here. So we've spoken about what Robert and family will owe to Australia as the RSUs vest. Answer: ordinary income at the highest marginal rate, because it kicks in rather early in Australia at $180,000. If he then sells the stock, well, he gets long-term capital gains discount, just half of his marginal rate. What about when he leaves taxable Australian property? Dylan went into some detail about that. What will he owe the US as the RSUs vest? Ordinary income tax. If he sells the stock, capital gains tax. And when he leaves, well, it's like Hotel California, isn't it? It's you can check out, but you can never leave. So, and that was why I asked that question of you, Dylan, earlier, not to try and throw you off, but how the immigration choices end up making big tax impacts. So staying on an E3 would be fine because his US tax residency would cease, but had he converted to a green card or a citizen, then it would be a very different situation for him, where those tax obligations would follow him until a relinquishment had occurred. Departure planning from Australia. So I don't think we had a slide specifically dedicated to that, but the takeaway that I have from today's presentation is settling up with the ATO and understanding what that obligation is at the time of your departure. And so I think that's a valuable service that we've performed here in letting you know that this even exists. Any financial decisions he needs to consider with that move will probably also what to do with that primary residence in Sydney. Australia is one of the least affordable real estate markets in the world. And as a result of that, rents don't keep up with prices. And adding on top of that, we have the non-resident tax rates, a host of other state level taxes. Those that have attended my webinars in the past will know that I'm incredibly bearish about owning so-called investment property from abroad in Australia. So my recommendation there would probably be to sell that, assuming that they weren't looking to move back to Australia after just a couple of years, and it was likely to be their primary residence upon return. And so that's been addressed there in question 3 as well. So settle up with the ATO, or at least if you don't, then know what that obligation is going to be in the future, so there's no rude surprise. And think about what to do with your primary residence. That wraps it up here. I want to hand it over. Whoops, I didn't actually close that quite so soon. Want to just see if anyone has any questions here. Would be happy to address in the time that we have remaining. So please feel free to write those in the chat panel or the Q&A panel, and Dylan and I will do our best to address those questions. While you're typing there, I just wanted to make an introduction to the newly formed AUSA tax partners. So we're still getting that website up, so it's not quite there on the web right now, but if you're seeking representation on the Australian side, then Dylan Goldspring would be the accountant I would recommend. And on the US side would be Steve Heinz, who's a CPA who's worked with many, many dozens of Aussie expats on their specific questions and issues. If you want to find out more, please go to my website, arete-wa.com for Wealth Strategists Australia, to find out more resources, or if you want to find a time to speak, then click on that Get Started button. We've also got the screenshots that you've seen of the key financial data sheet available here, and the webinar will be uploaded to YouTube very shortly. So Dean has written in. Dean, thank you for your question. You didn't cover selling your primary house before leaving Australia. Yes to know the answer, but just letting you know you skipped it. Actually, that's not true. I did cover that just at the very end, Dean, and that was when you're right insofar as I didn't cover it until the very end when I was covering off on those on the financial planning considerations that the client has. So I don't think it would make sense if they were moving to the US for a period of time beyond a couple of years to keep that. But you know what? Let's invite a different opinion. Dylan, what's your general thoughts about owning Australian real estate from abroad?
So there's a question there, Dean, which I might even cover off on a little bit more detail. So we're talking, I'm assuming your question's mainly geared in the angle of it being the primary place of residence. So a typically non-taxable sale in the event that Sydney property was sold. So again, if that Sydney property was sold when leaving Australia, yeah, okay, perfect. So principal place of residence. So exactly right. If that was the principal place of residence, a non-income producing asset, and you did sell it prior to ceasing residency and leaving for the US, it is a non-taxable gain because it was primary place of residence and there is no need to pay tax on that. Now, one other consideration I will highlight there is the 6-year rule, whereby if no other residence in Australia is declared to be your primary place of residence for 6 years, that primary place of residence will follow that property. So there is the occasion where it may be not detrimental to own that property for a longer period of time, subject to the 6-year rule. But you're correct in the sense that if they sold before they left, non-taxable gain if they were solely living in it.
Dylan, my view on that is, as you heard me say earlier, I'm incredibly bearish about holding on to real estate when you leave. And here's the reason why, is because when you're overseas, you don't have a CGT discount. So any gain from the time you depart until the time you sell, any gain in that period is treated as a non-resident rate. You potentially lose your primary residence exemption that you're talking about after a little while. And furthermore, if the property is income producing, then you're paying tax at the non-resident rate. So I just don't see it. Someone might be really clever and say, oh, well, couldn't you just contribute that money into superannuation and for a concessional contribution? Yes, but what does the IRS make? What does the US make of a move like that? They see it as taxable income. So it's taxable income no matter what. And so that's how I land on my position of being just don't hold it. It's just not a good use of your funds. There don't seem to be any other questions. We've had a few minutes for folks to get them typed out. Thank you, Dean. Oh, anonymous. I don't know what it is, but it's whenever we are just about to wrap up, people suddenly come up with their questions. Oops, I bought Aussie shares by Concept while I was in the US. Okay, that's not quite as bad as I thought. You were saying shares, not managed funds. That's a very important distinction. I've been advised to sell them due to the US tax implications. When I sell them while still in the US, will Australia tax me? Love the question. Let's, with an anonymous here, let's first confirm that they are not ETFs or managed funds, because if that were the case, they would be passive foreign investment company holdings, which is bad news. If they're individual shares, if you bought BHP or Comsec or whatever, then that's a different story, in which case it's really pretty straightforward. It's not such a, oh dear, okay, they are PFICs. Well, that is bad news. Yeah, so will Australia seek to tax you on them? I don't believe so. Dylan, good thing we have you on the line here.
Yeah, I again wouldn't believe so. I think primary place of tax is going to likely be the US, but at the same time, I'd probably want to review the entire situation before confirming.
And then Jen has written in with a comment. I don't think it's a question, so much as a comment. New ATO changes really penalize you if you leave intending to keep your Australian primary place of residence, but are forced to sell. Yeah, that's what I was saying, exactly. To sell while a non-resident, especially huge capital gains in property. This is the thing. I truly think that departure planning from Australia as a subset of financial planning is completely understood, under-communicated, because the impacts are massive, as we've seen here today. We're now at the hour mark. Dylan, I want to thank you so much for your time here again. Let me go to your contact information. We see right here. So there's Dylan's contact information if you wanted to reach out to him with any questions, concerns, doubtful points. Otherwise, thank you very much, and we'll be back next month with another exciting installment here with financial planning issues for Americans and Australians in America. Thank you so much, and have a wonderful rest of your day.
Thank you, everyone.